Hey everyone, welcome back to Corporate Decoder, the place where we break down the financial secrets companies tried to hide from you, and today we are diving into Box Inc.'s latest quarterly report, their 10Q, and let me tell you, things are definitely interesting in the world of cloud content management as Box navigates a changing economic landscape while pushing forward with AI and new product launches. Before we start, if you appreciate getting straightforward insights from these dense corporate documents, make sure you're subscribed. We also have a vibrant Discord community linked in the description below where we break down these filings in real time. Box Inc., a company that provides a platform for managing cloud content and securely sharing it across devices, is providing its quarterly report for the period ending July 31, 2025. This is essentially a mid-year checkup on their business performance. Right off the bat, the company is confirming it's meeting all its reporting requirements, which is a good sign of compliance. They are also confirming they are a large accelerated filler, meaning they are a bigger established company. Now, before we dive into the numbers, the company is giving us a heads up that a lot of what they'll say is about the future. They use words like expects, plans, anticipates, and they want you to know that actual results could be very different. They're essentially saying things might change and we aren't setting anything in stone. It's standard corporate practice, but always good to keep in mind. Let's jump into the financials, starting with the balance sheet, which is like a snapshot of what the company owns and owes. As of July 31, 2025, Box had total assets of around $1.62 billion. That's down slightly from about $1.67 billion at the beginning of the year in January. On the other side of the coin, their total liabilities are $1.4 billion down from $1.47 billion. They've managed to reduce their liabilities somewhat, which is generally a positive sign. Now, here's an interesting part. Their total stockholders deficit is negative $269 million. This means that if you were to sell all their assets and pay off all their debts, the shareholders would technically owe money. This often happens with companies that are still growing or have significant past losses. Moving on to the income statement, which shows how much money they made and spent over a period. For the 3 months ending July 31, 2025, their revenue was about $294 million. That's up from $270 million in the same period last year. That's a solid 9% increase year over year, which is good to see, especially in a potentially tricky economic environment. For the 6-month period, revenue was $570 million, up from $535 million last year, also a healthy increase. Their gross profit, which is what's left after paying for the direct costs of delivering their service, was $232 million. For the quarter same period last year, it was $214 million. Their gross margin is holding steady at around 79%, which means for every dollar of revenue they make, they keep about 79 cents after covering the direct costs. That's a pretty healthy margin in the software world. Now for operating income, which is profit before interest, taxes, and other things. For the quarter, it was $20.5 million, which is slightly up from $23 million last year. However, their operating margin, a percentage of revenue, has dipped slightly from 7.5% to 7.0%. This indicates that their operating expenses grew a bit faster than their revenue. And finally, net income, the bottom line. For the quarter, Box reported a net income of about $13.4 million. That's quite a drop from $25 million in the same period last year. This drop in net income translates to basic earnings per share. It was 6 cents this quarter compared to 10 cents last year. Diluted earnings per share also saw a decrease. This decline is something to watch. This statement is about other income and losses that don't come directly from their main business activities. They had other comprehensive income of $3.7 million this quarter, up from $1.1 million last year, mainly due to positive adjustments in foreign currency translation and cash flow hedges. This table shows how the ownership structure of the company has changed. We see here shares being issued under employee plans. These are common for tech companies to incentivize their employees with stock. They also repurchased some of their own stock worth about $40 million this quarter. Companies buy back stock to reduce the number of shares outstanding, potentially boosting earnings per share, or because they believe their stock is undervalued. Now let's look at cash flow, how much actual cash is coming in and going out. In the 6 months ending July 31, 2025, Box generated $173 million in cash from its operations. This is up from $67.5 million last year, so their core business is bringing in more cash, which is a good sign for their day-to-day operations. They spent about $16.5 million on capitalizing software costs. This means they are investing in developing their own software that they'll use internally and are treating it as an investment rather than an immediate expense. On the financing side, they used about $127 million. This is less than the $15.7 million they used last year. This difference is largely due to them repurchasing fewer shares this year compared to last year. Overall, their cash pile increased by $33.4 million this period, bringing their total cash and equivalents to around $60 million. Looking at how they present their business, Box provides what they call an intelligent content management platform. Basically, it's a way for businesses to securely store, manage, and share their digital documents and files from anywhere. They are really pushing the AI aspect with new tools like Box AI Extract Agents and Box AI Studio. Revenue from the United States accounts for about 62% of their business. Japan is their second biggest market at 26%. This shows a significant reliance on these two regions. As with any financial report, management makes estimates and assumptions. They are reminding us that actual results could differ from these. They mention that most of their revenue comes from the United States and that no single customer accounted for more than 10% of their revenue in the last quarter. That's good no over-reliance on one client. However, for accounts receivable, 2 resellers accounted for more than 10% of their receivables. Box uses financial tools called derivative instruments like foreign currency forward contracts to protect themselves from losses due to changes in currency exchange rates. Especially with their business in Japan and Europe, they are designated as cash flow hedges, which means the positive or negative outcomes of these contracts are tracked separately. The company also took charges of about $8.2 million for a workforce reorganization. This usually means they've let some people go or are investing in restructuring efforts, which can impact short-term results. Their deferred revenue, which is money received from customers for services not yet delivered, is $547 million, down from $608 million. This is linked to their revenue recognition, where they recognize money over time. They have $1.5 billion in remaining performance obligations. This is essentially future contracted revenue that they expect to earn. About 55% of this is expected to be recognized in the next 12 months. Box has $166 million in money market funds, which are generally very safe investments, and $100 million in US Treasury securities, also considered very safe. They also have $4.3 million in forward contracts designated as hedges. These are financial tools to manage risk. Their total assets measured at fair value are around $273 million. They also have convertible senior notes. In September, they issued $460 million worth of notes due in 2029, and they have outstanding notes from 2021 due in 26. These notes have fixed interest rates, so changes in general interest rates won't directly affect the cost of this debt, but their market value does fluctuate and it's influenced by Box's stock price. The estimated fair value of these notes is over $700 million combined. They show here the notional amounts of their outstanding currency forward contracts. For hedges, they have $113 million this quarter and $70 million in contracts not designated as hedges, bringing the total to over $183 million. Box has operating leases for its offices, and those costs are around $6.5 million per quarter. They also have sublease income reducing that cost. Looking ahead, their future lease payments for operating leases are quite significant, totaling over $110 million in the coming years, not counting what they get from subleases. They have about $12 million in letters of credit outstanding for things like their office leases, and over $183 million in purchase obligations, primarily for cloud hosting and software services. These are contracts they are committed to pay for in the future. Let's talk about debt. They have those convertible senior notes. The 2029 notes total $460 million and carry a 1.5% interest rate. The 2026 notes total $25 million and notably have a 0% interest rate. However, they did repurchase a large chunk of these back in 2024. Remember that convertible preferred stock we mentioned earlier, well, as of July 31, 2025, the company had paid $7.5 million in cash dividends to these preferred stockholders and still owes about $1.3 million in accrued dividends. Their board of directors has approved a stock repurchase program, and they bought back about 2.8 million shares for roughly $90 million in the past 6 months. They still have over $112 million left to spend on repurchases. Stock-based compensation is a big deal at Box. They have nearly 17 million restricted stock units outstanding with an average fair value close to $30. This means a significant amount of their employee compensation is tied up in stock and its future value. For the quarter, stock-based compensation was about $60 million spread across their departments. That's a substantial hit to expenses that doesn't involve cash outflow, but it does dilute existing shareholders. Looking at expenses as a percentage of revenue, research and development was 24% sales and marketing, 35%, and general and administrative 13%. While these have stayed relatively flat or increased slightly as a percentage of revenue year over year, the company states they expect R&D and S&M to decrease as a percentage of revenue over time as they grow. We'll see how that pans out. The drop in net income is clearly reflected in the earnings per share figures. Diluted earnings per share for the quarter came in at 5 cents, down from 10 cents last year. Their provision for income taxes was about $10.33 million this quarter. This is up significantly from $4.5 million last year. This increase is partly due to them releasing a valuation allowance on their deferred tax assets and increased foreign income taxes as their foreign operations become more profitable. Box is really leaning into AI, touting new products like Box AI Extract Agents and Box AI Studio. They also recently launched an enterprise advanced plan to offer more powerful features. Their revenue growth of 9% for the quarter is good, but it's important to note that currency fluctuations favorably impacted this by about 2 percentage points. So the underlying growth might be closer to 7%. Their remaining performance obligations, a measure of future contracted revenue, grew 16%, which is a strong indicator of future sales. Let's talk about billings, which is a key metric for SaaS companies. Billings for the quarter were $264.9 million, up 3% from last year. However, currency fluctuations are said to have negatively impacted this by about 2.5 percentage points. So again, the underlying growth is a bit different than reported. The 6-month billings were up 13%. They define non-GAAP free cash flow as cash from operations minus capital expenditures and software development costs. For the quarter, this was $35.7 million, up 9% from last year. That's positive, showing healthy operational cash generation after necessary investments. Another key metric is net retention rate, which measures how much revenue they are keeping and growing from existing customers. The rate is 103% as of July 31, 2025. That's good, meaning they are retaining almost all of their customers and growing revenue from them by about 3%. They attribute this to their product offerings and customer success efforts, even amidst tougher economic conditions where customers are scrutinizing bigger deals. Now for the risks. Box lists quite a few, and frankly they are pretty standard for a growing tech company. Intense competition is always a concern, as is the need to keep customers renewing and expanding their usage. They also highlight risks related to AI product issues, data security and privacy laws, and their reliance on third-party cloud providers. They also mention that a classified board of directors and anti-takeover provisions could make it harder for someone to buy the company. They acknowledge tough competition from giants like Microsoft and Google. They admit their retention rates can bounce around. They specifically call out the risks associated with AI integration. You know how we talk about AI being a double-edged sword? They also emphasize the critical importance of data security, a standard but serious concern for any company handling sensitive information online. And that tax provision increase we saw earlier is partly due to them reversing a valuation allowance on their US deferred tax assets. This basically means they now believe it's more likely than not that they will be able to use those past tax losses to reduce future taxes. Now, looking at Box's overall financial picture, they are showing some positive signs with revenue and cash from operations growing. Their gross margins are strong and their net retention rate suggests they are doing a good job keeping and growing business with existing customers. However, the dip in net income and operating margin for the quarter is a concern. The company is investing heavily in future growth, particularly in AI and new product suites, which explains the increased expenses. But the net loss on a per share basis and the very large accumulated deficit are still headwinds. Competition remains fierce, and the company's heavy reliance on the US and Japan for revenue is a concentration risk. They are trying to diversify and grow internationally, but that comes with its own set of challenges and costs. Their commitment to AI is a strategic bet that could pay off big if they execute well, but it also introduces new technological and security risks they need to manage very carefully. The strong repurchase program shows confidence from management, but also uses up cash that could be deployed elsewhere. In conclusion, Box is navigating a complex environment. They are growing their top line and bringing in more cash from operations, which is solid. But profitability and margins are under pressure. Their future hinges on successfully integrating AI and their new product offerings while managing operational costs and intense competition. It's a company with potential, but also significant risks to monitor closely. Alright, that's our breakdown of Box's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.